You know, if you've read any news over the last couple of years or you've seen any headlines, you've probably seen a trend of one specific phrase. For the consumer, this would look like going from beef to chicken, or from fresh to canned, or just from brand name to private label. And if you followed this trend and then pick stocks based on it, you probably made quite a bit of money. But not every boat in this category of trading down did succeed, as seen in the performances of retailers like Dollar General, Grocery Outlet, and Five Below. The models these businesses had characteristics that should have made them able to capitalize and thrive, but they didn't. Now, let me add one more business to this equation. Believe it or not, Ollie's is not one of the businesses that failed to capitalize. It's actually one of the winners of this story. However, you wouldn't be able to tell that if you're just looking at the chart. With a growing footprint in the southern United States and a business model that would bring customers in and out every single week to treasure hunt for new products and deals being rolled out for their favorite brand names, Ollie's would go out and source these products from brands that overproduce their inventories or stores that like went out of business, and go to the big box retailers and say, hey, you couldn't sell this? Give it to us. Just give us a really big discount to food, furniture, books, generators, fucking gnomes even. It's the commitment to give deep discounts to consumers that has grown Ollie's into a $5 billion business with a footprint in 35 states and a store count that's looking to double in under a decade. It's not going to be the best stuff. It's also not going to be the worst stuff, but it is going to be the best price. After all, good stuff cheap is the slogan. Their loyalty program, which accounts for 80% of their sales, makes it so that they don't have to ask the question, what are people willing to buy? They have to ask the question of, what does our customer want to buy? Because this program allows them to have all the information they need to track and make strategic decisions based on the preferences of their shoppers. Ollie's is a store that never has a consistent inventory. So when a customer goes in, they're always looking at something new. So this info is very valuable because they know they're going to be able to bring in a product that they know their customers actually going to buy. And in physical retail, maintaining your margins means that you cannot have products sitting on the shelf or on the floor that is occupying space not being sold when you could have something else there. And speaking of retail sales, we got to talk about shrinkage. As in like customer stealing and like cashiers being dumbasses, not like, look, I I think like you. I know at least one of your dumbasses did. Not only compared to their competitors, but in general compared to retail, they have the best metrics in terms of retail shrinkage. Because for years, while the industry has been dealing with high amounts, at least historically high amounts of retail theft, Ollie's has been at record lows, and that is for a couple of key reasons. Number one, they didn't fall for the self-checkout thing. The stores are also built in a way that deters casuals from stealing. And finally, they have stores that are comprised of items that have almost little to no resale value at all. And so if you stack that all together, you are left with a thief that can't do a switcheroo at self checkout. There's nowhere in the store that they can reasonably go and pocket a bunch of items out of sight from cameras and employees. And if you're going in with the idea that you're going to steal something from an Ollie's and then go out and resell it, like, how do I, like, thieves go for small things with high value, you know what I mean, like electronics, makeup, stuff like that. But at Ollie's, you're not gonna go in and then like steal a book or a poster, something with like no resale value at all. So already phenomenal start. Let's talk about the numbers though. Now, growth for this company has actually ticked very consistently upwards in the double digits. The key number that you want to look at is gross margins, which have been able to tick even faster because every unit that is put on the shelves is being put on the shelf faster and more efficient through their logistics network that is able to work to a more efficient capacity with every new store that's opened within their area of operation. They're also able to lower their fixed costs compared to their peers, at least, by opening new locations in previously occupied spaces that were vacated by other retailers that may have left, moved, or just passed on from whatever that market is. This is also a double positive because in a growing business, they don't have to worry about building a completely new facility for their specific purpose. All they have to do is just move into the space and adapt and just build around what they have. Actually, this is a triple positive because then they're able to go to the landlords and negotiate a really favorable long-term lease because they'll take the building as is. Quarter after quarter, year after year, continuous growth. And then the street got ahead of itself. It got way too excited. The trouble started last year when the company was wrapping up its earnings report and then essentially said, while their same store sales have been great, the economy has been getting worse. And because of that, they can't expect that their stores in the future are going to grow at the same rate that they have been. And so while they're continuing to open new stores, and if anything, they're going to start opening those stores even faster, they're going to have to cut the same store sales growth from 3.5% to 1.7%. And then the rest was history. Ever since then, the narrative has just been completely negative, with bears coming in and saying a chain that has no e commerce is essentially destined to fail. They also said that the rate of expansion was just way too aggressive. The same store sales growth was just not going to be able to sustain the company at that rate. And that if a black swan event occurred in the market, this would just completely wipe out the company. The point of this business is that you have a person coming in physically to go look at items. It's not to go and browse online and just pick up at store and never step foot anywhere else in the store. Now, the rate of expansion is aggressive, but the funds for that expansion are coming from free cash flow. When you also factor into the fact that they're going to be spreading it across several distribution networks and several sourcing networks, the company can then go on to start benefiting from economies of scale. And then when we talk about a black swan event, just shit that just happens and you're like, oh, what the fuck? You can't really trip up a company whose only debt obligations lie with its suppliers and its landlords. There's no bank that's going to come out with its loan sharks and break some kneecaps whenever something goes wrong. There's only landlords that are trying to keep good tenants in the building, and suppliers like, the big box retailers and wholesalers and liquidation services that are trying to keep a business around that is willing to take on these products that no one else will. And so, if anything, these parties are incentivized to negotiate and, if anything, just extend terms with Ollie's. And so, really, the bottom line is that the business is growing fast, it makes money, and it has zero debt. Isn't that the ideal business? And so, last year, if one of you said, hey, go take a look at this, and I went and took a look at it, I'd be like, well, it's pretty good. I like it. But now, at this valuation, I love it. Right now, all that's needed for another run is just a change in narrative. And we might be seeing it already. Don't trust a guy on the internet. Not even a guy. You're listening to a cartoon. But don't, just let me know what you think in the comments or message me on Discord. That's all I really have to say. So, yeah, bye.